Welcome back to the deep dive. Today we're really getting into the weeds on Nike, the global sportswear giant, ticker NKE.
It feels like a really pivotal moment for them.
Exactly. And the big question we're trying to unpack here is, is this recent slump just Nike catching its breath? Or is it something more serious, maybe signs of a permanent decline?
Right, and that's the key for anyone looking at the stock. We're framing this as a deep fundamental investigation. We're anchoring everything to that closing price of $70.89 on September 20, 2025.
Mm-hmm.
For value investors, this is, well, it's the classic question, isn't it? Is this weakness temporary or is there real structural damage here?
And just a reminder, as we pull out the key insights from all the reports and filings, this deep dive is part of our bigger project covering the S&P 500.
That's right.
So please do like and subscribe to Stock Analytics AI. Our members at $4.99 a month get priority access for ticker requests, but hey, non-members, you can always drop a super thanks for a one-off deep dive.
Okay, so the plan is, first, we'll tackle the core stuff, the business itself, the management changes, and the financials, chapters 1 to 3.
Got it.
Then in the second part, we'll look at market sentiment, who owns the stock, the risks involved, and then finally, wrap it all up with our conclusion, chapters 4 through 7.
Sounds good. Let's kick things off then. Chapter 1, Business Analysis. Where does Nike actually make its money?
Well, fundamentally, it's pretty straightforward. Designing, developing, and selling athletic gear. Footwear is the big one, over 60% of sales.
Right.
Apparel is next, about 30%, then equipment. And the big brand names are obviously Nike, Jordan, and Converse.
But their strategy, the one that seemed to work for ages, has hit a wall recently. I'm thinking about that big push into direct-to-consumer.
Yeah, the consumer direct acceleration, that's the term they used. The idea was to prioritize their own channels, Nike.com, the SNKRS app, their Nike Town stores mainly for, higher margins and direct customer data.
Makes sense on paper.
It did, but the execution, well, that's where the strain showed. It looks like a bit of an over-rotation. They alienated some key wholesale partners in the process.
And the numbers show it.
Oh, definitely. The data is stark. Fiscal year 2025, fourth quarter, Nike direct revenue actually fell 14%. That's huge.
Wow, 14%. And what drove that?
It was dragged down massively by digital commerce. That segment dropped a staggering 26%.
26%. Okay, that explains the shift we're seeing now.
Exactly. It's a forced pivot, really. Management's language has changed. Now they're emphasizing meeting consumers wherever they choose.
Which basically means?
It means they need those wholesale partners back, the ones they kind of pushed aside. They need them to regain that lost market share.
Okay, so distribution was one issue. What about the actual products? Are the shoes still selling?
Well, yes and no. The classics, the icons like Air Force One, the Dunk, they're still incredibly profitable, real cash cows.
Hi.
But the sources suggest they might have relied on them too much. There's talk of product fatigue.
Ah, okay. Consumers getting a bit bored.
Sort of. And that creates an opening. Nike still has a dominant U.S. footwear share. What is it, 34.97%?
Still massive.
It is, but these newer, more agile brands are chipping away, especially in performance running. Think Hoka, think On. They've been really smart, innovating quickly, and grabbing dedicated followings there.
So internal strategy issues, tough competition. What else? Any big external headaches?
Oh yeah, geopolitics. There's a significant regulatory threat. The company itself estimates that potential new U.S. tariffs on imported goods could add about $1 billion in gross incremental costs.
$1 billion. Oof.
Yeah. Tackling a billion-dollar headwind like that, it puts immense pressure on leadership. Which brings us neatly to the next point.
Right. Chapter 2. Management evaluation. There's been a big change at the top, hasn't there?
Absolutely. A really significant leadership transition. Elliott Hill took over as CEO in October 2024. He replaced John Donahoe.
And Donahoe's focus was very much on tech and that DTC model.
Exactly. His vision was tech-centric, very DTC heavy, and, well, we just discussed how that ultimately faltered. Hill coming in is a very different signal.
How so?
Hill is a Nike lifer. 32 years inside the company. His return suggests a deliberate pivot back to, let's say, Nike's core DNA, product innovation, managing the marketplace effectively, strong brand storytelling. They seem to want a seasoned operator, a real shoe guy, to steer the ship now.
Okay, so new leadership trying to right the ship. But what about how they treat shareholders? You mentioned capital returns earlier.
Yeah, despite the operational mess, this is one area where Nike remains incredibly strong, very shareholder-friendly.
How strong are we talking?
Well, they returned $5.3 billion in fiscal 25. And they have a huge ongoing $18 billion share buyback program authorized.
That's serious cash back to investors.
It is. And here's a really key fact for long-term investors. Nike has raised its dividend for 24 consecutive years.
24? Wow,
That puts them right on the cusp of becoming a dividend aristocrat. It speaks volumes about their historical financial discipline, even now.
But that historical strength seems at odds with some current metrics, right? You mentioned a AHA metric.
Yes, the return on invested capital, or ROIC. This is probably the clearest single number showing the recent efficiency collapse.
Okay, break down ROIC for us. What is it telling us here?
So ROIC basically measures how well a company uses its money, both debt and equity, to generate profit. For years, Nike was, frankly, a machine at this. Their 5-year average ROIC was impressive, 20.1%.
And now?
The last 12 months figure, the LTM ROIC, it's collapsed to just 12.4%.
Ouch, that's a dramatic drop. What's behind that?
It really quantifies the pain we've been talking about. It's reflecting two big things. One, profits are getting squeezed because they're having to discount heavily to shift all that inventory.
Right.
And two, way too much capital is just tied up in that bloated inventory. Getting that ROIC back up will be, I think, the most tangible sign that Elliott Hill's turnaround strategy is actually working.
Okay, that makes sense. Let's move on then to Chapter 3. Financial analysis. Let's look at the raw numbers. Market cap around $104.7 billion, you said. What about the top line, the revenue?
The trend there is not good recently. Fiscal year 2025 revenue actually fell to $46.31 billion. That's a drop of 9.8%.
Minus 9.8%. That really breaks that long-term growth story Nike always had.
It does. It's a significant contraction and a break from the norm investors were used to.
And this is hitting margins hard, presumably.
Absolutely. Gross margin is down to 42.7%. Net margin is even tighter at 6.95%. That's quite a bit lower than their historical levels.
Reflecting the discounts and higher costs we talked about.
Exactly. It costs more to compete, and they need to clear out old stock. It bites into profitability.
But what about the overall financial stability? Is the company solid despite the profit pressure?
Oh, yes. If you look past the income statement for a moment, the balance sheet is still very strong. You could even call it a fortress. Financial stability isn't really the concern here.
What metrics show that?
Well, their debt-to-equity ratio is quite manageable at 0.83. And importantly, their current ratio is excellent at 2.21. Meaning they have more than double the liquid assets needed to cover all their short-term debts and obligations. They definitely have the financial muscle to weather this current storm.
Okay, strong balance sheet. Now, how is the market valuing the company right now? Let's talk valuation. The PE ratio.
Right. The trailing 12 months price to earnings, or TTM PE ratio, looking at the price relative to the last year's actual earnings, stands at 32.82.
How does that compare historically and to competitors?
It's interesting. It's actually below Nike's own 10-year historical average PE, which was around 36.4. So expectations have clearly come down a bit, but it's still trading at a premium compared to key rivals. Adidas is around 28.8, Under Armour even lower at 22.1.
So the market is still betting on a recovery, expecting the issues to be temporary.
It seems so. It's pricing in that powerful brand mode. There's an expectation that Nike will sort things out.
That faith in the brand brings us nicely into the second part of our analysis. Let's talk about Chapter 4, market sentiment. What's the general feeling out there on Wall Street?
Well, the official analyst consensus is a moderate buy, but that label hides a lot of disagreement.
How so?
If you dig into the individual price targets, they are all over the place, extremely polarized. The low target is way down at $38 a share.
Oh, very bearish.
While the high target is an incredibly bullish $120, that wide range tells you Nike is a real battleground stock right now. Lots of strong opinions on both sides.
Does the technical picture tell a similar story? The charts.
It really does mirror that fundamental uncertainty almost perfectly. The stock is currently trading below its 50-day moving average. That's $75.17. Which typically signals negative short-term momentum.
Okay.
But crucially, it's holding just above its 200-day moving average, which is around $70.28. That longer-term average often acts as a key psychological support level.
So short-term pain versus potential long-term resilience.
Exactly. The technicals are painting the same picture as the fundamentals. Immediate challenges, but underlying support based on that long-term strength.
What about short interest? Are lots of people betting against the stock?
It's moderate. Around 3.12%. That shows there's definitely some skepticism out there, some doubt about the turnaround. But it's not an overwhelming level of bearish conviction you might see in a company perceived to be, truly on the brink.
Okay, interesting. Let's move on to Chapter 5, Ownership structure. Who actually controls Nike?
Well, on the surface, institutional investors dominate, holding about 67%. You see the usual big passive names, Vanguard, BlackRock leading the pack.
Pretty standard for a large cap.
Yes, but what's not standard is the insider ownership. It's exceptionally high at 20.90%, and that's almost entirely dominated by the co-founder, Phil Knight, and his family trusts.
20% insider ownership is huge. And doesn't Nike have a special share structure too?
It does, a dual-class share structure. This is really important for understanding control.
Explain that for the listener. What does dual class mean for someone holding the publicly traded shares?
It means the Knight family, mainly through an entity called Swoosh, LLC, owns over 97% of the special Class A shares. These shares carry super voting rights,
Leaving them.
effective control. They get to elect 9 out of the 12 board directors. So if you, as a listener, hold the Class B shares, the ones that trade publicly, you're essentially a passive participant. The Knight family ultimately dictates the long-term strategic direction.
Which can be good or bad, right?
Yeah.
It shields management from short-term market whims, but maybe slows down change if needed.
That's the classic trade-off of these structures, exactly. Okay, so let's turn to Chapter 6. Risk assessment. We'll use a SWOT framework here and revisit that geopolitical risk.
All right, let's break down the SWOT. Strength first.
The biggest strength, undeniably, is that iconic, unmatched brand moat. Decades of cultural relevance, plus those unique long-term athlete endorsements, think Michael Jordan, LeBron James. It's a huge competitive advantage. The main weakness we've discussed is the recent execution fumble with the DTC strategy. Also, maybe an over-reliance on footwear, particularly those few classic lines we mentioned earlier.
Opportunities. Where's the potential upside?
The clear opportunity is the turnaround itself under Elliott Hill's experienced leadership. Getting back to basics. Plus, there's still growth potential in areas like the women's category and in key emerging markets.
And threats.
The threats are pretty clear, too. That intense competition from nimble players like Hoka and On isn't going away. And of course, those broader macroeconomic headwinds, inflation, potentially reduced consumer spending could definitely hurt demand.
Okay, and let's circle back to that huge external risk, the $1 billion potential tariff impact. You said Nike has a plan.
They do. They're not just sitting there. Part of the plan involves mitigation through supply chain adjustments specifically, accelerating diversification away from China for goods bound for the U.S. market.
Makes sense. What else?
The other key part of their mitigation strategy is potentially riskier. They've indicated plans for surgical price increases in the U.S. market starting in fall 2025.
Raising prices right when competition is fierce and consumers might be feeling squeezed.
Exactly. That's the tightrope walk. Can they raise prices enough to offset the tariffs without killing demand and losing more share? That's a huge execution risk right there. If they raise prices but volume plummets as a result, the whole exercise could backfire and actually worsen the margin situation.
That's a critical point. Okay, this leads us perfectly into the final chapter, Chapter 7. Conclusion. Let's synthesize everything. Start with the bull case. Why might someone invest now?
The bull case really hinges on that incredibly powerful brand moat. It's weathered storms before. Add to that the operational reset under Hill, a known quantity, an insider focus on fundamentals. Plus, you have that very strong capital return program, especially the dividend track record. The argument is that the bad news, particularly the DPC failure, is largely priced in, offering upside if the turnaround gains traction.
Okay, now the bear case. Why stay away?
The bear case is all about the risks. High execution risk on the turnaround plan. Intense, maybe even increasing competition. That quantifiable drop in efficiency shown by the ROIC collapse. And of course, that looming, concrete, $1 billion geopolitical cost headwind from tariffs. There are significant hurdles ahead.
So putting it all together, where does our valuation analysis land?
Based on our discounted cash flow modeling, synthesizing all these factors, we estimate the intrinsic value range for Nike shares to be somewhere between $65 and $80 per share.
Okay, $65 to $80. And the stock price when we anchored this analysis was $70.89.
Exactly, right smack in the middle of our estimated range.
So the market basically sees it as fairly valued, perfectly balancing the risks and the strengths.
That's how it appears, which means the investment decision for you, the listener, isn't really about finding a mispriced stock based purely on numbers right now. It becomes a qualitative judgment. Meaning, you have to ask yourself, do I truly believe Elliott Hill and his team can navigate these challenges? Can they reinvigorate the product pipeline, manage the competition, handle the tariffs, and execute this turnaround successfully?
Right. Your answer to that question determines whether you think the stock is more likely headed towards the $65 floor or has the potential to reach that $80 ceiling or perhaps even higher long term.
Precisely. It's a bet on management execution and brand resilience.
A very clear takeaway. Well, that wraps up our deep dive into Nike for today. Thank you so much for joining us.
Yeah, thanks for listening. And maybe one final thought to leave you with for reflection.
Sure.
If Nike is going to successfully fend off these really focused niche competitors in the long run, which of its core assets do you think will ultimately be more decisive? Is it going to be that amazing portfolio of iconic athlete endorsements? Or is it the potential power of its digital ecosystem? The NTC and NRC training apps, the data they generate, the community they build. Which one holds the key? Something to mull over.
That's a great question. Food for thought indeed. Okay, folks, remember to like and subscribe to Stock Analytics AI. As we mentioned, we're covering the entire S&P 500 over the next few months, and our Pillen members get priority access and requests for these deep dives.
And just the necessary disclaimer before we sign off. This analysis was generated by an AI system. It's intended strictly for educational and informational purposes. It is absolutely not financial advice.
That's right. You must always conduct your own thorough research and due diligence before making any investment decisions. Thanks again for tuning in, and we'll catch you on the next deep dive.